Today's video from Father and Son Investing is going to talk about this question: does size matter when it comes to investing? We're talking about the differences between investing in mega cap versus small cap versus large cap or mid cap stocks. Much of what I had to say today is going to come from this paper from Clifford Asness and a whole bunch of other contributors, the title of which says, "Size Matters If You Control Your Junk." Now, this paper goes into a lot of statistics, etc., which I'm not going to talk too much about because that's going to be pretty boring. We're going to try to keep this lighthearted and informative so that by the end of this video, you'll be able to know whether investing in small cap stocks, particularly a certain group of small cap stocks, can improve your investing outcome. So let's get started. I want to show you this graph first because I think it might help keep you motivated to keep watching this video and learn what it is that's going to make a difference. Do you want returns that look like this, or do you want returns that look like this? And there's just a simple difference between these two. Now, before we get to what that difference is, we're just going to talk quickly about small cap stocks because some people may not have a good grasp of what I'm talking about. And we're also going to touch on the importance of small cap stocks when it comes to your returns. All right, small cap stocks, what am I talking about here? We're talking about the capitalization of a company. The way that we come up with that market capitalization is pretty simple. You take the number of shares outstanding, you multiply that by the current stock price, and that will give you a market cap. So when we do that, we end up with different sizes of market capitalization for different companies. We're talking about large cap stocks, 10 billion plus. Of course, now there are also mega cap stocks. When you're looking at companies like Apple, we're talking about companies that have $1 trillion in market cap. Now, why is this important? Well, tradition says that actually small cap stocks in the long run will beat large cap stocks. This is from an article by Craig Israelson on ETF.com, and this graph kind of shows you that. We see that the 95-year annualized return, small cap stocks will beat the large cap stocks, and even when we look down here at the growth of the 10,000 over 95 years after inflation, a significant difference between small cap stocks. It doubles what the large cap stocks did after inflation. Now, small cap stocks have been less popular during this century, and that is because the returns have been a bit less robust. Nevertheless, it still remains important to have some small cap stocks within your portfolio. This chart here shows that importance. This is taking the 2-asset 60-40, meaning 60% equities and 40% bonds, versus the 3-asset 60-40, where we chop out some of the 60% large cap stocks and instead we throw in 20% small cap stocks. Then if you want to compare here how these do, you'll see that the average annualized return is better. You'll also see that the growth of $10,000 over that 95 years is significantly better. All right, so now everyone should know what a small cap stock is when I'm talking about that, and you know the importance of having some small cap stocks within your portfolio. Now we're going to cover just a little bit of background here. In 1981, an investigator named Bands found that small stocks in the U.S. had higher average returns than large stocks, and he was using historical data to come up with that. However, since that time, this size premium really has not been as demonstrable as it was in the past. However, Mr. Asness and his group found that if you controlled for one factor, that this size premium came right back out. And what was the factor? It was quality, or the inverse of quality they termed as junk, thus managing your junk. They go on to describe 4 quality measures. The big one I think here is profitability, meaning small cap companies that are profitable being in the quality section, and the inverse, small cap companies that are not profitable falling into the junk section. Then when they ran those numbers controlling for quality, this is QMJ is quality minus junk. When they ran those numbers controlling for quality, you see the difference in these kind of returns. We're talking about 1.5x versus more than 3x. The other thing that I want to point out to you on this chart is when the small cap stocks not controlled for quality are dropping, those controlled for quality in here are going up most of the time still. Here is the other big reason why I want to point out to you why it's important to control for quality. This shows the number of junk stocks within the small stocks and the number of junk stocks within the biggest stocks. This maroon color here, you can see makes up 30 to 40% at any given time of the small cap stocks, versus over here in the large cap stocks, we're talking about 10%. So when you control for quality, you find yourself investing in these upper 2/3 of the small cap stocks. Right now, you may be asking yourself, well, that's all great, but how do I go about doing that? Well, if you want to take the time to read a lot of annual reports on small cap companies and figure out whether you want to invest in them, that would be a very large undertaking. There is one way to go about doing this. There is one ETF that I found. I'm not sponsored by this ETF. I certainly am not encouraging you to buy it. I'm just trying to explain that there is somebody out there who's trying to control for this. You'll see here that Dimensional will have some of these small cap portfolios that you can invest in. And the title here says small caps that may be holding back your portfolio returns. They go on to describe the same sort of thing that I just talked about, the junk that exists within the Russell 2000. They even go on to show you the 5 small cap stocks that were the biggest detractors in the Russell 2000 during 2021. One of these I'm a little more acquainted with, Invitae. I have invested in that, and I'm taking a huge hit on my investment. Now, this works not just with the capitalization, but by other measures of a company's size. So one can be price to book. And we see that they went on to compare price to book and profitability. If you look at companies that have high price to book and low profitability, these ones that tend to fall in this sort of orange sector, we'll see that it's a negative return for 2021, and they are highly concentrated here versus out here in the low price to book and high profitability range. Now, why am I telling you all of this? Because Dimensional states down here, Dimensional seeks to avoid these stocks in our portfolios in small caps, such as those shown in Exhibit 4. Now, there may be some other small cap ETFs or mutual funds out there that are also trying to control for junk. I've at least given you one example. Surprisingly, the fee that they apply to do this is really not that much. This is the expense ratio for their ETF. You'll see that the management fee is 0.3%, and when you tack in all the fees, it's 0.34%. To me, that doesn't seem like that much when you're trying to look at all of these small cap stocks and figure out which ones are going to be profitable and meet those quality criteria. So does this actually work in real life? Let me just show you here. I've given you a number of small cap funds, and these are going to be compared to the Russell 2000. Particularly, we have in orange the DFAS and DFSTX, which is a small cap fund available from Dimensional as well. This one you have to go through some financial advisors to be able to get to it. Nevertheless, we're going to look at the breakdown here and just see whether it actually works over the long haul. Now, this is only since 2019 on this, because I've also thrown in RYLD, which has only been around since 2019. We're going to come over here to ending value. If you look at the Russell, you're looking at 13,000, almost 500. And then if we compare that to DFSTX, you're well ahead of that, 14,180. And if we also look at DFAS, you're just shy of 14,000 on that. So both of those funds, using the controlling for junk, managed to outperform their benchmark, the Russell 2000. If you're wondering about how this compares to the S&P 500, I have that graph before you now. I took out RYLD so that we could get a little bit better track record going back to January of 1999. In black is the S&P 500. You can see that all of these small cap funds or ETFs are beating the S&P 500 significantly. S&P 500 at 57,000, earnings over of 10,000, and we'll see that all of these are 80,000 or above in comparison. What does that say to me? It says having some small cap funds within your portfolio is a way to increase your earnings and also diversify. All right, that's what I have for you today. The answer to the question, does size matter in your investing? And the answer is yes, if you control the junk. I hope this information was useful for you. If it was, please give us a thumbs up, and we'd love to have you as a subscriber. Please share this information with a young person in your life. Imagine how much of a difference you can make in their investing by getting them started early and helping them to diversify, including possibly some small cap ETFs. You'll see a huge difference, or they will see a huge difference potentially. Remember, past performance does not predict future performance. Make investing a family affair, and as always, enjoy your investing.